this week, the story's been 30-year bonds. As they sit, they're down 20 basis points on the week. They were down over 25. Historical, all-time, forever even, low yields. And this contract was introduced exactly 42 years ago today. Happy 42nd birthday, 30-year bond futures. And Richard Doc Sandor right here is the man who wrote the specs for the contract. Congratulations.
Thank you, Rick. It's great to be here with you.
But, Doc, that isn't even the story today.
Right.
The story today is you wrote another contract that's being launched today. Why don't you tell us about it?
It's a substitute for LIBOR, Rick, and it's a hat for you. AMERIBOR futures are being launched today, and it's a LIBOR replacement. $200 trillion of assets have to be repriced with this new index or SOFR.
Now, the Federal Reserve also has a competing product, and of course, it's called the Secure Overnight Financing Rate, SOFR. What's different about AMERIBOR, your contract being launched today?
SOFR is fantastic. It is a risk-free rate, and therefore is different than AMERIBOR, which is unsecured. Rick, it's back to the days of the TED spread.
For those who don't remember TED spread, it's Treasuries versus Eurodollars, secured versus unsecured, and there's going to be arbitrage there, and then you'll be able to read some market signals on credit quality.
Yes, and I think we're going to have a family of benchmarks, just like we have with crude, just like we have with stock indexes, just like we have fixed income. The days of a single benchmark for the entire world is a civilization gone with the wind.
LIBOR, the London interbank offered rate, is basically set to retire, forced retirement due to questionable pricing. That's in 2021. The issue was that the groups that priced that contract, which Eurodollars converged to, maybe we're fudging it a bit. What will prevent the underlying index of your contract to have a similar fate?
AMERIBOR is a market-based solution to an index. It's not set, it's not a call-around, it's based on actual trades on the American Financial Exchange between many, many different banks.
And my final question is, last I looked, there were a boatload of financial structures, even things like mortgages, that are still tied in pricing to LIBOR. Is the lead up to this, with all these contracts still active, is that going to be bumpy, or have our regulators and the Federal Reserve done an adequate job to taper us into this new era?
I think the regulators have done a great job. This is the same scariness that people said about Y2K. It came and went without a flutter. The Fed's doing a great job. The big banks are getting prepared. We're preparing the regionals. And I think it's going to be Y2K. We're going to get there. The day will flip.
Richard Doc Sandor, good luck in your new contract. We all still use your first contract.